Today is May 4th, and we are starting this series on point and figure analysis. And I am extremely thrilled to have Bruce Fraser, my friend and my mentor for a long time, to actually conduct these sessions with me together. So this is for students that are present here from the Advanced Wyckoff course. This is a more unusual format, but it's going to be very exciting. We had a lot of buzz about this series, and I'm just excited to welcome Bruce today to our class environment. So let me tell you a little bit how I met Bruce. I think I took my first Wyckoff classes at Golden Gate University back in 1996-97. And Hank Pruden and Bruce taught the classes together, and I took Wyckoff 1 and Wyckoff 2 class. And it was just an amazing material. I thought at the time how deep it was, covering the market structure, and also I was extremely pleased with the teachings of Hank and Bruce. And Bruce has been teaching Wyckoff method at Golden Gate University at that time already for quite a few years. So later on I've asked Bruce to mentor me, and it was not just mentoring about the Wyckoff methodology, but other trading related issues, and Bruce was just gracious enough to extend that mentorship to me. I still consider Bruce one of my two mentors. Hank is another one, and so every time we collaborate on any type of projects, I'm extremely excited. So I know that we're going to have a great series. We've done this before with Bruce. Last time we did this, we had a big success. A lot of people commented on how deep the material was, and the interaction was so great. So I'm looking forward to the same kind of synergy for these sessions as well. Bruce, could you introduce yourself a little bit? Tell us about yourself. What do you actually trade? How do you use Wyckoff method? How did you actually encounter Wyckoff method first? And what are you doing specifically with the point and figures right now?
Well, Roman, thank you for the kind words. We've certainly done some great work together, and I've enjoyed our mentorship as much, and probably gotten more value than you probably got from the relationship.
Oh, wow.
But so it works both ways.
Thank you.
I have a great passion for the Wyckoff method, and it's pretty much what I do exclusively. Probably the thing to do is to go back to my graduate school days at Golden Gate University. I was taking finance classes, and I was probably about halfway through my program, getting my degree, and a professor who I thought was one of my better professors, suggested that I take this class on technical analysis. And he said, it's a little controversial, but I think you're really going to enjoy it. And I didn't know what technical analysis was. I had grown up in the horse racing industry, and I owned one stock in my life, and that was the stock of California Jockey Club, which owned Bay Meadows Racetrack, which is where I worked. And so that was the extent of my understanding of stocks and stock ownership. And so I take this class from Hank Pruden, and honestly, I think it was the second or third class of that semester, I knew that this is what I wanted to do the rest of my life. This was going to be my career. And it just had such an impact on me, and I so love the material, and I consider Hank to be my mentor, one of my mentors, and so, you know, it was a rare thing. At the end of that semester, I was depressed. The semester was over, which was a first for me. And so then, when I was finishing up my degree program, I went to Hank, and he talked a little bit about Wyckoff in the technical analysis class. And at the end of my my program at GGU, I went to Hank and I said, "Will you sponsor my thesis?" And so he graciously agreed to do that. And he had a project in mind, and it was a Wyckoff project. And so I spent that entire semester immersed in Wyckoff and primarily doing research on price and volume. And subsequently, that research, we were able to publish it. And it was published in the MTA journal. And so that was terrific. And so I was off and running. And you know, fast forward to 1987, Hank decided that he wanted to take a break from teaching. He'd been teaching since 1976 at Golden Gate, teaching technical analysis. And so he asked me if I would teach the class for some period of time that was undetermined. And so I started teaching the class in 1987.
And that was a technical analysis class.
Correct. And that was the survey course. And really enjoyed doing it. I did it for, 4 or 5 years. And then I went to Hank, and he and I had been working on some other projects, and by then I was deeply ensconced in Wyckoff. And so Wyckoff was it for me. And even though I taught the survey course, I pretty much had devoted myself to the Wyckoffian methodology. And then I went to Hank, and we're not really sure about the year. I think it was 1991 that we sat down and I said, "Hank, I'd really like to teach a class on Wyckoff." And so we were talking about expanding the curriculum and adding classes to the technical analysis offerings. And he said, "You know, I've been thinking about doing the same thing. Let's do it together." And so that's how it started. And so since 1991, maybe 92, we've been teaching this class on graduate course on technical analysis in the Wyckoff method, and then also the basic survey course, FI 352. And we started off the first semester, the first time we taught it was a one-semester class. And we had so much material, and we discovered that teaching point and figure analysis and point and figure charting methodology was particularly problematic, and that it took more time than we thought to be able to adequately teach the concepts of point and figure. And so we added a second semester and expanded some of the other material into the second semester, and then devoted much of the second semester to point and figure charting. And so point and figure is, it's akin to riding a bicycle. And point and figure is once you've got the concepts, you got them for life. But learning them is a little bit like riding a bike, in that it's awkward and unusual, and it takes a little bit of work to get your head around how to do it. But once you got it, you got it. And so we're going to, I think, be able to spend a meaningful amount of time working on the construction and the methodology here, and then get into interpretation, because Wyckoff does point and figure differently than anybody else. It's unique unto itself. And so there's a richness of material here, and we're going to have a lot of fun with it. So anyway, I'm going to shut up at that point, and let's move on to the important stuff.
Sure. But I just want to reiterate two our audience that you've been exposed to Wyckoff methodology for over 30 years. You've used Wyckoff method for that period of time. You are, as I know, successfully trained using the methodology. You are also a big point and figure guy on the with the Wyckoff kind of like underlying approach to point and figures to point and figures. And I think it's such a value for our audience to have you here for this particular session from that perspective, because for me personally, I do teach point and figure charting at Golden Gate University as a Wyckoff 2 class. And for those of you who are interested in attending, and we have two versions of that class. One is on campus, which is taught by Professor Prudham, and I would highly recommend if you live in Bay Area or somewhere close to take at least one class with Hank, because it's an extremely big value to be in his class. And if you can't make it, then there is an online class that I teach, and point and figures is being taught, as Bruce mentioned, in the second class of our Wyckoff education at Golden Gate University. So it's exciting, Bruce, to have you here. Thank you for walking us through your path to Wyckoff methodology, and I'm sure that we hear some other stories, during all these three sessions. Okay, couple of notes. We have a really good group here. The majority of participants are students of the Advanced Wyckoff course, so you guys kind of like know the rules of engagement of how we conduct the sessions. There's going to be a slight change. Primarily, the interaction is going to be between me and Bruce, but as always, you can always type in a question as we go through the material, and I will try to stop myself and Bruce at the specific places and bring this question for a discussion. Also, during the third session that we're going to have on May 18th, we will welcome any submissions of the case studies that you might have on the point and figures. And we will talk about this during the second session on May 11th, how I would like you to submit those. Obviously, I would like you to label those case studies, and we'll talk about this. It's probably going to be more in line with the count guide, where you submit your vertical chart labeling first, and then the point and figures, and then we can go through this whole process together. So we'll do that. I am recording these sessions, and both recordings and slides are going to be available to all of the participants, and we're going to distribute these recordings and slides after May 18th or earlier. That just depends on how our team is going to edit those recordings, what are we going to add to those, and so on and so forth. So we'll do that probably either before May 18th or slightly after. Today, we're going to talk primarily about what's the difference between the construction of the Wyckoff way of point and figures. We'll talk about why do we want to use point and figure charts for our analysis. And we also will go through the Wyckoff count guide. And if we have time left, and we might go slightly beyond 5:30 Pacific, so we might stay a little bit longer, just depending on the time and the material that we've covered. By that time, we might go into the case study, which is going to be Apple. All right. Let me see if there are any questions at this point. If there are none, then we're just going to move. Okay, so first question. Able to show how to do point and figures on TradeStation as example later in this course? Yes, we will definitely show you two point and figure sources. I believe that Bruce can show us the stock charts and how he uses stock charts for his point and figure analysis. And I will show you on the TradeStation specific ways of how to construct the Wyckoff one-point reversal. There is just a small nuance right there. So those two sources for the point and figures are going to be discussed. We're also going to use some charts from other softwares, and we'll definitely mention and refer to those sources as well. All right. I think we're ready to go. All right, so Bruce, right here, I want to quickly mention where in the Wyckoff methodology we are encountering point and figures. This is the slide that I really like. It's usually the first slide that I put on to explain the methodology in general. So really quickly here, we have the main three Wyckoff laws. These are the laws that Wyckoff was talking about the price and volume and the causality. And the third law here, this is where we are going to reside for these 3 sessions. It's the law of cause and effect. Basically, it states that there is a proportionality between the causality, which is for us a trading range, a consolidation, a structure, some kind of structure, and the effect that takes after that. So a trend that takes place after the consolidation. And of course, everything is interconnected here. So we will not necessarily talk about, let's say, 5 Wyckoff steps, but we can see that in the 9 buying, 9 selling tests, we do have some tests that are related to the point and figure charts right here, these 3. And also, of course, a lot of discussions that Bruce and I will have are going to be related to our phase analysis, because we need to understand how we would label those phases, and also the Wyckoff point analysis. And that's going to be combined together to determine where we would take those counts. Bruce, anything else here to add?
I think I'll wait, because there's some things I want to talk about cause and effect, but I think that there's going to be a better place to do that.
Okay, all right. Okay, so this is just an overview, quick overview. All right, and this is the slide where we're showing the examples of all of the laws. So we're not going to go through the first 2. This is more related to our supply and demand class. But on the third one right here, for the cause and effect, we see that in the 2008-2009 trading range right here, and this is Goldman Sachs, we have the point and figures of one box, Bruce, help me out here. A little bit, I can't. If you can do this, I think it's 1 by 3.
It looks like 1 by 3.
Yeah, 1 by 3. Yeah. So this is how the point and figures would look. This is from the TradeStation, and just a little bit, not a clear view here, but yeah, I think this is 1 by 3. So we're looking at the trading range, the causality of this trading range, which is later on is being projected as a count into the upswing right here. And this is what primarily we will be studying for this 3 sessions. In this
1 by 3 simply means it's 1 point. The boxes are 1 point, stock point, and it takes 3 boxes to reverse the trend from down to up or up to down.
Yes, absolutely.
That's,
And we will show today how we would, well, first of all, why. We'll discuss why we need those, the reversals and box sizes. And we also will discuss different ways of putting different charts. So we might have two 2 points for the box size and let's say 1 point reversal, or we might have 3 point reversal. So we can construct different point and figure charts, and we'll discuss those concepts today. All right. Okay, well, this is the chart where, Bruce, I think that we can have some kind of discussion here. And the name here, why would we use the point and figure charts in our analysis? So I'll give you the floor here. And I think that, in the preparation, we've discussed that this is a very important topic. So let's try and spend some time here and identify those points of usage for us.
Well, on a point and figure chart, you can see that it has a family resemblance to a regular vertical bar chart. And so you can see even that there are dates along the bottom, but that those dates can vary, because how a point and figure chart is going to be constructed is that you have in the columns, you're either the red boxes are prices moving down. In this case, there's different ways to do this. The green X's are prices going up. And so the only thing that can cause a change from one column to the next as you keep moving to the right is that you have a change in the direction of price by some minimum amount. And so in this case, this is a 3-box reversal chart of Apple. And so it takes 3 full points of reversal in the price of Apple from up to down. So it'd be 110, it'd be 109, 108, 107, and then you've had a significant turn, a turn of a significant number of points to turn the columns from up to down or from down to up. And so the way to think about a point and figure chart is that it's not a function of time on the x-axis, it's a function of volatility. And so as prices move to the right, it's because there's been a minimum amount of price volatility in the opposite direction that has caused the columns to be moved to the right. And so the result of that is, and I've had endless discussions about this, is that one of the main features, and this is a very powerful tool, and I believe the point and figure charts are one of the best kept secrets and one of the most powerful tools in all of technical analysis. And very few people know how to do what we're all here discussing and what you're learning how to do, which is how to take a horizontal count on a point and figure chart and derive from that horizontal count a price objective. And so it's amazing how this works, and we can discuss why it works, but for now, let me just say that this process of prices going in this accumulation, you're all Wyckofians, so you know that this is an accumulation phase. And so this accumulation phase is, we know that it's the process of absorption. It's the absorption of shares from weak hands, which starts at the climax on the left side of the accumulation, and getting all the way over to the right side where stock is systematically changing hands from weak holders to strong holders, from the public typically, but it doesn't have to just be public. It can be other institutions and so on, over into very strong hands, which we call the composite operator. And the composite operator, when they have, and there's multiple composite operators that all want to build big positions in these stocks, in this stock in particular, and that's why they call it an accumulation phase, is that they've built up their position, they own these shares, and the only thing that's going to get them to sell those shares is much higher prices. And so the degree to which the composite operator is able to wrap up or absorb as many shares as possible in this accumulation phase, which is one of the ways they do it is to create endless volatility, just prices going from the top of a trading range to the bottom, back to the top, back to the bottom, over and over again, which is unnerving to the public. It's unnerving to the amateur trader, the amateur investor. And so they become unnerved, they sell their stock. And so the CO is consistently building up a position through this volatility. Well, this volatility is really well represented by a point and figure chart. And you can see here this magnificent point and figure count, which has created, you can now take and create objectives for the potential for how much the stock can go up by simply, not well simply, but by what we're going to learn is by counting across from right to left. The way that Ramon is drawing this out is to count the size of the base and then project up the potential price objectives.
Okay, awesome. Bruce, there was one thing that you said that resonated with me so much. You were talking about the volatility in the trading range and how that's going to be reflected on the point and figure chart. So here we have in the trading range and even in the upswing right here in the trend, we see this time reference and we see how much space it takes, and it's not always equal, right? So like this month right here in May, it's actually less columns right here than in April. And then if we go even further back into where volatility is the highest on the climactic action, automatic reaction, early phase B, we see that October and November are actually the first the months that have probably the highest volatility, and therefore the price is spending a lot of time here creating those columns up and down. Is that going to be a tendency for the trading ranges where
Yes.
they're going to
Notice how, and remember how we are always looking for evidence of absorption, which I know you talk about a lot with your students, is notice the big red columns on the left side of the accumulation phase. Look at how wickedly large all those are as it climaxes and then goes into into the accumulation phase. Those are just wickedly large, and they are massively unnerving for the public. And you can see that as you go further and further to the right, and stock is being absorbed by the CO, that the red bars are becoming smaller and smaller, which is evidence of absorption, and that tells you that there's less stock that's floating around out there that's available for sale or for accumulation.
Okay.
So that's a very good point. So you can spend you can have a lot of volatility in a short amount of time, very characteristic of the left side of an accumulation. And you can have less volatility on the right side and have it take longer. And so the amount of time, or time is a variable thing in a point figure chart. It's volatility that drives the plotting of the chart. It's not time. So that's why we use only two kinds of charts, primarily two kinds of charts in Wyckoff, and that is a vertical chart and a point figure, because they both do different.
Just an idea came to my mind as you were talking. You know, probably for the mechanization of consolidations, we can use even the point and figures, the number of columns in a specific time period, to identify that we are in a consolidating environment, because we can assume that increase of the volatility will increase the number of columns, and therefore we're in somewhat of a sideways action here.
Love it.
Also, a really great remark, and I want to everybody, our students to please pay attention to what Bruce said about the absorption going from the left to the right of the trading range. All these columns that are huge columns here to the downside, and then the contraction of those red big columns, going through the trading range. There is definitely less of a result moving to the downside, and that's a change of behavior. And we've discussed change of behavior lately in the last 2-3 months a lot. And also you can also see this on the upside, where we have smaller moves here to the upside, and then suddenly, and on the point in figures, sometimes it's much clearer to be seen that that change of character. We'll see that there is a rally that exceeds all of the rallies in this area, and it's probably only this rally that's going to be at par with the one on the sign of strength right here. So Bruce, would you say that point and figure charts sometimes are much clearer for you than the vertical bar charts in terms of how the price actually moves?
No question. There's clarification that you can get from the point and figure chart, and it just stands out to you. It just becomes really evident because you don't have all the noise of the bars, the highs and the lows in the bars, and that can, if you're not careful, it can add a lot of noise to the analysis, where the point and figure charts can strip that noise out, because the only thing that determines how the plotting is just the volatility as you go up and down. So it takes a major swing, especially in a 3-box reversal chart. It takes a major swing to plot the next column. And so it tends to be, the chart tends to have less of that sort of volatility or noise that you'll see in a vertical chart.
Okay. I also find it's very interesting, and I think it's very unique to all of us humans, how our brain operates. Whenever we look at the vertical bar chart, we usually look at the volume as well. So there are so many more pieces of data that our mind has to process. With the point and figure charts, it is really clean. There are no instances of big extremes, and it's much smoother, and there is not necessarily that we have to have the volume data here. We potentially can add volume data, and we'll talk about this a little bit later on. But it's definitely a much clearer picture, and our minds are have less information to absorb here, and therefore it's just easier to interpret and easier to analyze. Would you agree, Bruce?
Yes, no question.
Okay. All right. Some other uses for the point and figures that we can mention here. So Bruce talked about looking at the causality and measuring this causality and projecting the causality for the upcoming trend. We also can.
So the count, which you just drew with that vertical line, is the effect, and then the count across the x-axis would be a measurement of the cause, because we just talked about cause and effect. So that's what is meant in point and figure construction. Is the effect is the objective, the price objective that's measured by the width of the cause in the base or in the accumulation.
Okay. Also, another use for the point and figures for us, and this is reflected in the 9 buy and 9 selling test. We can talk about the risk and reward analysis. So Bruce, how would we use this concept with the point and figures?
Well, it's interesting, because I was just thinking about that. Like, there's a couple things we can do. One is, first of all, we're looking for a hurdle rate. And this is really important to me. I'm much more concerned with getting an adequate hurdle rate from my counts than I am in the counts necessarily working out perfectly, even though they tend to work out really well. It could be that the count, and this is exactly what happened on Apple, is that Apple actually went above the counts in that accumulation phase. And so, but the count, the objective, the effect or objective that the count created was very attractive. And so you're talking about a stock that was trading in, say, from $80 to a little over $100 in the accumulation phase, and counted up to call it $180, just for simplicity's sake. And so the hurdle rate is the rate that the count suggests is possible in the accumulation phase. And so we're looking for always a 3-to-1 reward to risk at a minimum. So the risk that we're taking is to our stop. So where we enter the trade and where our stop is, and the reward is 3 times that or more. And so you can see that just in the case of Apple here, that it easily exceeds a 3-to-1 reward to risk. And so it meets our minimum objectives for a hurdle rate. So the hurdle rate is the most important thing in my mind about the potential that is promised by the cause built in the accumulation phase. The other part of it is that let's say that we have 2 stocks that we're looking at in this sub-industry group. So, and just for the case of discussion, we're looking at Apple and we're looking at Hewlett-Packard. And here we are at the end of a bear market, and we're looking and we say, okay, here's 2 stocks, I only want to own one. And so I go look at Hewlett-Packard and I look at the construction and the potential that's built in the cause of its accumulation. And I look at Apple's and I compare them and I go, Apple's is better than Hewlett-Packard's, and Apple's has shown the attributes of relative performance jumping out of its base and starting to mark up before Hewlett-Packard's. And I don't recall Hewlett-Packard's chart back then, but I'm using this as an example because you can do this with any sister stock, so to speak, in industry groups or however you want to look at it. And so you look at 2 stocks and you say, which one has the greatest potential, the greatest cause, greatest potential effect or hurdle rate. So you can compare stocks that way also, which I'm sure as we have time, we'll be discussing that in more detail.
Absolutely. Okay. Just to reiterate this point on the reward and risk, because it's extremely important concept here, let's look at this area right here. Let's say that we are thinking that this is a backing up action or a last point of support after the sign of strength in phase D. So we are looking to establish the position, and on the vertical charts we are finding a point of entry for us. And let's say this point of entry was let's say 108, and our stop loss here is going to be at below this low right here, so at let's say 103. So our stop loss, the risk in points, is going to be $5. So that's our risk in points. And we're not talking about the risk of equity for this position, but a risk in points for this position. And let's say that we have, well, let's say we have a conservative count right here that projects the objective of, let's say, what did we say, 180? So let's say 180. So from the point of entry to this area right here, we have a potential profit reward of $72. So our reward to risk ratio is 72 divided by 5, which is going to equal about 14 to 1. So Wyckoff would tell us that whenever you have a minimum of 3 to 1 as your reward to risk ratio, this is worth considering. And the whole idea here is that, and it goes to the actually statistical concepts. The more trades you have, you want your reward to exceed the risk by a certain measure, because you are going to have some losses, and you want to cover those losses with the trades that are going to reward you with the profitability. And therefore, by comparing these two stocks that Bruce was talking, let's say Hewlett-Packard and Apple, at this time in 2008, 2009, some of the decision making, and Bruce, please, correct me here if I'm wrong, is going to be based on what is more attractive from this perspective of the reward to risk ratio. Is Apple having bigger causality, and therefore the projections are going to be much, much higher, or Hewlett-Packard? And of course, this is done after the analysis, as Bruce said, on the comparative relative analysis, structural analysis, and so on and so forth. Bruce?
Well, it just gives you a sense for the richness of how point and figure analysis adds this tremendous dimension, which is the ability to be able to estimate the potential for a move. Now, there certainly is risks in this analysis, because sometimes accumulation is not accumulation. It looks like it's a count, it's maybe a gigantic count, but in fact, there's nothing going on there. And that's a discussion that we hopefully can have in the next week or two.
Mm-hmm.
Is when is accumulation? And so we largely tell that from the vertical chart, but we also can tell somewhat, as we just discussed, about absorption from the point figure chart itself. And so but the richness of this research that we can do in terms of being able to estimate potential, and even if Apple did not reach its potential, but when it's only as high as this chart went, say to 150, it was a substantial trading opportunity, even if that's as much as far as the stock ever went. And so the potential can be greater or less. In this case, Apple actually exceeded the count of the accumulation, and there were some other future counts that were made that helped to keep us on board.
Mm-hmm. All right. Okay, we also will discuss a couple of advanced techniques for Wyckoff point and figure analysis. Those are going to be a phase analysis, and when the Wyckoffian hears phase analysis, we're most likely are going to think about the structural analysis of the trading range. We are definitely going to operate within the trading range, but our point and figure phase analysis is going to be slightly different than the vertical bar phase analysis. So we'll stop and spend a lot of time talking about the phase analysis, because what that allows us to do, and I can divide this chart into different phases here, 4 phases. It allows us to project where the price is going to stop on the way to the ultimate objective here. So we'll talk about that, and that's probably going to be more of a second session. And then very exciting timing mechanism that we can use with the point and figures for the stepping stones. So again, with this phase analysis, it allows us not only to project where the price is going to stop at the specific point, but also when the price has to leave the stepping stone to fulfill its final objective. So that's a very exciting timing tool that we're going to introduce to you guys. All right, let's jump to the next slide. And I do see a question, and we're definitely going to address this question with this slide right here. And by the way, this slide starts with the Wikipedia piece, and this is taken, I believe, from Hank's reference. You know, he likes to think about different laws of physics and how they can be applied into the market. So one of these laws that he talked about was Hooke's laws of elasticity, and basically the whole motto here at the top right here is as the extension, so the force. So it all comes to the idea of the cause is going to be proportionate. The effect is going to be proportionate to the original causality, and that's why it's so crucial for us to understand what is in the cause. You know, what is the potential for the move that we have in this cause. All right. Well, we're gonna spend some time now discussing different aspects of the point and figures, and specifically how Wyckoff looked and applied point and figures. And I'm going to be asking Bruce a series of questions, and through the discussions, we're going to answer probably quite a few questions that you guys might have at this point. So the first question, Bruce, why do we use point and figure charts in addition to Wyckoff bar, price, and volume analysis? Couldn't we just use the price and volume as a standalone tool?
Well, actually, many people do because they don't quite get their heads around point figure. But I think we sort of alluded to it in the last slide, which is that the richness of being able to use point and figure to be able to give us price objectives. And the thing about horizontal counting, they're software programs, as you've all seen. Software programs give you price objectives for point and figure charts, and those are vertical objectives. And so what they do is they take and they measure a vertical space, typically inside of a trading range of some kind, and then they project that up, just the way Roman drew this, where that first arrow, the lower arrow, the computer calculates that and then extends up that count up to the next level. But as you could tell from that Apple example, there's no way that you could get a vertical count that would take you up to 180 on the price objective of Apple. And so horizontal counting has a whole different type of a richness to it. And so it allows you to be able to get some substantial counts. In the next week or two, I actually have some old presentations I did a while back that maybe we can go through briefly, where I actually did a case study on point and figure charting of the residential construction industry group back in 2002, 03, in that era. And it's really quite a remarkable case study at being able to give you very large counts, which are like multiples of the base. And so the ability of another point to make here is that these counts, whether you're doing one box reversal counts, which are like the equivalent of a daily bar chart, a 3-box reversal, which is like a weekly chart, or a 5-box reversal, which could be like a monthly chart. These principles can work across much larger time frames, daily, weekly, monthly. I mean, those are just approximations, but you can really get some perspective on a very large scale about how much energy there is in the accumulation phase or in a distribution phase.
Okay. Also, could we say that point and figure analysis is a convincing strategy for us to stay in the trend once it's underway? Because if we know what the causality is in the the number of points that the trend might potentially travel, it might keep us in the trend during the stepping stones and give us more confidence to stay through those stepping stone consolidations.
Absolutely. And once we become fully committed to point and figure as a tool, and we are able to, commit ourselves to the point and figure analysis as being a very valuable tool, and can trust in it, believe in it, and believe in our analysis of it, there's no question. There's a great book that's out of print called The Professional Commodity Trader by Stanley Kroll, Kroll.
Mm-hmm.
And the book's not in print anymore. But if you go through and you find copies of it, it's just a terrific read, and about somebody who's a very long-term, campaign-oriented commodity trader. And so I loved reading about him because he's campaign-oriented. Well, so he talks about point and figure charts. So I went out and I started doing a little more research on his approach, and it's very Wyckoffian in nature, even though he doesn't
Mm-hmm.
talk about Wyckoff. But Stanley Kroll used point and figure charts, which he constructed himself in his office on these commodities, and those point and figure charts are what he used to give himself the price objectives for how far these commodities could go, and then he would trade these monster moves in commodities, which he documents in this book. And so if you can find a copy of it, read it. But when he talks about point and figure, he's talking about horizontal counting of a point and figure chart in commodities, and that was his convincer strategy to stay in the trade to the end. And so there's a great example of somebody who reveals to us his actual trades, and it's just a great read.
Mm-hmm.
If you can find it.
Okay, maybe for the second session we might have the name of the book and just post it before the session so that people will look for that.
Sure, absolutely.
Okay, and also we're going to show you in some of the case studies where those objectives that we take as a horizontal count, they seem so unreal at the time. We're going to look at Apple example in 2003 trading range where at the price of between $5 and $10, we have an objective of over $200, and it's really difficult to put our minds around such large objectives. And of course, we will show you the ways of how to think about those objectives, because we have to go from the conservative objectives to more aggressive objectives. But it would be such a great convincing strategy to have those long-term targets. And if you're a trader who campaigns positions, then it will be much, much easier to hold on to your original position through the stepping stones, which might be quite volatile. So we'll show you the examples of those. All right, Bruce, we have one question. Can you rationalize why target setting works? Or it's an observation, empirical evidence, or we don't care why it works? It just works, or we don't worry why it works? So that's kind of like the question. I think that the primarily idea here is what's the rationalization of why it works?
There's kind of two ways I would answer that. One is that I have one of the things, the advantages that I have, unfortunately, here is that I have the advantage of years and years and years of using these charts, and I have experience with them. And so that gives me an element of confidence that they work. The other answer I would give, and I want that experience for you, but the only way you can get that experience is just to do an endless amount of point and figure The other thing is, let me think here a sec. Well, the thing with point figure charts is that they have been in use for hundreds of years. They used them in Japan. They've used them on the New York Exchange. If you go to in the old days when they had, like these big pits where these guys were making markets in the pits, and they had a very robust exchange in San Francisco, which I used to go down to the floor and see my friends. And they all had these little cards. And on these cards, what they were doing was they were plotting the point figure charts of all the stocks that they traded in. And then what they would do is they would do horizontal counting on shorter time frames. But they were doing horizontal counting of accumulations and distributions that would unfold over the course of a day or a few days. And point figure charting and the use of these conventions for point figure charting have been around for hundreds of years. And so I think that what we know is that accumulations that occur over time, and that there's been, through observation, there's been the refinement of how to do counting. What are the grids to use? How many points? How to do the counting? How much to count? All of those things are trial and error experience that go back to the time of Wyckoff in the early 20th century and before him. And so these conventions have been developed over many, many, many years and many chart experiences. And so I think that that's a big part of the reason why they tend to work the way that they do. We know that accumulation is stock changing hands from weak to strong hands. We know that once the stock gets accumulated in strong hands, it marks up easily and effortlessly. But we know that the accumulation was the signature period where the CEO was putting bids underneath the lows of the accumulation range, and that they were checking their buying at the top of the range. So we know by definition that the accumulation range was the absorption of shares over time. That's what stops a downtrend. The only thing that stops a downtrend is some large interests start to accumulate these shares, and they're willing to stop the decline to put a bid under the market. And so what all point figure does is it gives us a way to be able to approximate how much accumulation is taking place. A narrow base is going to result in a lesser advance typically. A bigger base is going to give us a larger advance because there's more accumulation that's been able to take place.
All right.
It's not a great answer, but to me it's a great answer, but I can't just, state that science has shown that this is what's going on. I've had technicians, professional, well-known people that you've all heard of, sit down and tell me, I can't make any sense out of point figure, or point figure doesn't work. I've tested it in my computer systems against everything imaginable, and I can't make sense out of it. And the thing is that computers can't count horizontal counts. It takes people with experience and knowledge to be able to count horizontal counts. It takes knowledge and experience to be able to do this.
Okay. I think it's also very contextual, right? And Wyckoff method with its vertical chart analysis helps us to identify those counts, which computers might not necessarily see.
Right.
I always call this kind of like a very linear thinking approach to, a very complex problem where you have a lot of variables. I personally don't like those type of, mechanical back testing that are out of the context for the structure. So, and I also heard a lot of such remarks, from, technicians as well. And that's primarily what they do. It's just this kind of like very linear approach. So
it absolutely plays to our advantage. Our little group here learning how to do this, it plays to our advantage that these quants can't make sense out of this. They can't quantify it. And so the fact that this takes the human mind to be able to synthesize the vertical bar chart analysis that we learn in Wyckoff to the horizontal counting methods which Wyckoff used, and be able to synthesize all that, and the fact that the quants can't get there from here is, and it's also difficult to do, and so most people don't do it, completely accrues to our benefit.
All right. Okay, I think that we've covered that. Let's maybe just speed up a little here. Okay, so I think that we've covered this question too. Why does this analysis work? Okay, does it work all of the time, Bruce, in your experience?
It does not work all the time. And sometimes, and typically when it doesn't work, it's because we haven't done a good enough analysis on the vertical charts to determine whether we have accumulation, distribution, or nothing at all. And so sometimes stocks just drift because there's no interest in them.
Right.
And they're not ready to go anywhere, and so they just go sideways forever and ever, and you could build a count that goes to the moon. But the thing is that there's no accumulation there. There's no there. There's, and sometimes accumulation is actually thinking it's accumulation. It may actually be distribution or redistribution for further decline. So this is the reason why we need Wyckoff analysis of the vertical charts, and to be able to develop a good eye for when we have distribution occurring or accumulation.
Absolutely, Bruce. And also, I might add to this that whenever new students come to, let's say, point and figure class, and they have used the horizontal counting of the objectives before, they're complaining about that it doesn't work all of the time. Sometimes it's related to the way how they actually conducted those counts. Sometimes people just don't know exactly how it should be done properly. So I've seen a lot of mistakes just in the mechanics of how it's done. Even if they're correct about the directional bias out of the consolidation, whether it's up or down, their counting might be, not that correct. So hopefully these sessions will help, this group to get the mechanics correct, and, just to increase the accuracy of that analysis.
This and just endless practice.
Absolutely.
Yeah.
All right. Is the point
General Omar Bradley during World War II? He was, I think, a math teacher, and he used to do calculus problems to relax himself. So he would sit there, and this is during the war, and he'd be like out in the battlefield, somewhere, and he'd be like sit there and just to calm down, he would do calculus problems. Well, we do point and figure counting to do the same thing.
I was about to say we do Wyckoff analysis.
Yeah, we just get charts.
Yeah, we just look at charts.
Yeah, and it calms us down.
Yeah, it really does. Okay, so is point and figure an accurate projection tool for us?
I think, well, especially as we get better and better at it, and it doesn't have to be. It doesn't have to be 100% accurate to be very valuable, because if it gives us an objective, and in our price objective, and the price objective exceeds our reward to risk ratio, and if we get close to it, or even if we only get, say, to a 2-to-1 reward to risk, or we get near 3-to-1, we have the potential to be able to exit that trade at a profit. And so it doesn't have to be, point and figure does not have to be a game of perfect to be valuable. But you're going to find as time goes on that it's remarkably accurate. It's a really good tool. And a part of point and figure is that we learn to be conservative in our counting objectives. That we work very hard at getting objectives that are like the phases that you showed earlier, where we take a phase and we say, okay, if we only get to the first phase, is this a good trade? And if the answer is yes, and we have 2 or 3 more phases beyond that, then we have the potential for a great campaign.
Okay. All right. Next question is a very common question from students, and this might come from just the usage of the volume analysis from the vertical bar charts, but sometimes, people refer also to something like a market profile, and they would like to see the volume on the point and figure. So obviously it's a little bit challenging, but in a lot of softwares we have that function that we can put the volume with the point and figure charts. Actually, in TradeStation you can do this. So the question here is, Bruce, can we use it? Can we use point and figure charts with volume? And in your personal point and figure analysis, do you do this? Do you find this valuable, or is it something that maybe we should disregard?
Speaking for me, I use vertical charts for volume, and I do not put volume on the point and figure charts. And I just use the point and figure charts I don't put anything else on them. And so my preference is to use the vertical charts with volume, and to use the point and figure charts in their classic construction, and that's what I do. And so if other people do use volume or feel that they have an edge with volume analysis, I'm all ears for that. I've seen point and figure charts with volume on them, and I've tried to sort of gain value from that, and sort of escapes me.
All right. Okay. Next question. I think that we've answered this question. Can we use point and figure chart analysis as a standalone analytical tool? Of course, and we've talked about this.
I've had numerous students that just trade the market on point and figure charts. And for those of you that like to make your own charts, which I know is rare, but I would have, and in my day, before I had computers that would do point and figure charts, I would do them by hand, and I would keep about 200 point and figure charts, and you can plot 200 point and figure charts very quickly once you learn how to do it. And then I've had other students, and to this day I have friends that plot point and figure charts on the stocks that they're campaigning or trading in, and they do them all by hand. And,
it's not just that they do this to have the point and figures on the positions that they have, but most likely they just want, as they do this with their hands, to feel the stock, so to say.
Yes.
To understand. Yes, to understand the behavior. So when you actually draw it on the paper and you put those boxes of X's and O's in, you actually mimic the movement of the price, and it's somewhat of an additional data that you get to your brain. And I remember when I first took Wyckoff classes, Hank had home assignments for us, to do the point and figures, by hand. And I remember like numerous charts that I went through and constructed for many stocks, and that just gives you such a great sense for the price movement of that stock. So that's a great exercise. Of course, right now it's a little bit more challenging to do this exercise. People tend to just go to the software. but maybe as an assignment for
Well,
number 3, maybe we should do that.
and I do know people that have very successfully traded the markets, traded stocks with just point figure charts.
Mm-hmm. All right. Okay. Okay, so we've talked about the difference between the point and figure and the bar chart, so let's just skip this question. Why do we have to define the box size and the box reversal? And also early on there was a question about how do we choose the point and figure size, right? So how do we choose whether we're going to have, let's say, a 1-point reversal instead of 3-point reversal, or what's going to be in one box, what size we're going to choose for one box?
Well, most of the point figure, I'd say almost all the point and figure charting engines out there use scaling, and they use half-point reversal or half-point scale under $15, and then 15 to 100 is one point, over 100 is 2 points, and so on. And so then we alluded to this earlier, one box reversal is sort of like the equivalent. It's not perfectly the equivalent, but kind of like the equivalent of a daily chart. And then 3-box reversal is very akin to a weekly chart. And so you count them differently, and you're measuring different size moves with those. But the other part about it is that stocks will tend to adjust themselves because, like, let's say Facebook is more volatile than, say, IBM or something, is that they tend to, because they're more volatile, they tend to adjust themselves for the amount of move that they can have. And so a less volatile stock will tend to have smaller count sizes, and they're less volatile, they're going to move less. And so because they have less volatility in the base, they're going to make smaller bases, they're going to move less. But that's the nature of the stock. A highly volatile stock is going to have a lot of swings inside of a trading range or an accumulation. It's going to build bigger counts. It's going to have bigger moves. And so these stocks tend to sort of define themselves in the way that they build count and are counted. And so it's kind of remarkable how that happens. And we'll see examples of that as we go.
Mm-hmm. All right. Okay, great. So we've got those questions. Now, let's talk about the construction of the point and figures. And in this case, we're going to talk about 1-point reversal and 3-point reversals. So this slide was constructed based on Hank Pruden's book, The 3 Skills of Top Trading. And obviously for advanced Wyckoff students, I've mentioned this book on numerous occasions. If you have not bought Hank's book, I would highly recommend chapters 3 through 7, all about Wyckoff method. And Hank has the point and figures examples there as well. And so all of this is from Hank's book. And let us go here and show you how we would construct the point and figures 1-point reversal first. So Hank has this period number 1, and the price starts from 37, and it travels to 36, then 37, 35, 36, 35. So let's look at this. Starting from 37, right here, this is our starting point. The next movement we have is to the downside, to 36. So here is the movement on the point and figures right here. Then the next move from 36 is going to be to 37, so we're going up. Then from 37 to 35, so we're traveling actually 2 boxes down, 36 and then to 35. and then we're rallying up to 36 again, and then we are declining to 35 again. So, and that's basically how we would draw and construct the point and figure charts based on the series of this price data right here. Now let's look at the second period right here. So we stopped at 35. We are, where are we? Okay, so we are right here. And then the next price is 34. So price still continues to the downside. From 34, we are jumping to 40 right here. And that's going to be reflected in this big move to the upside. And then there's going to be a big move to the downside. From 40, we go to 35 without any rebounds to the upside, not even a point. And then we go up to 36. So that's the second set of data. And then the third one, we're going to start with 36. So it's going to be right here. And then we go up and down, 35, 36, 35, 36, 35, we are right here, and then the big move to 40. Here we go. So, and that's how we would construct the point and figure chart based on these three periods right here. Now, how would we convert, Bruce, how would we convert this 1 point reversal movements into the 3 point reversals?
Well, let's take a second and cover one important thing about this one box reversal chart, is that there's a convention in Wyckoff, and there were some others that use the same convention back in the old days, and there's a lot of software programs that don't do this correctly, is that in a one box reversal chart, you have to have at least 2 entries in each column. And this is it only applies to one box reversal, but you can see there that Ramon has marked each of the periods where there was 2 entries in a column. And so, for instance, you could have it goes down to 35, and then there's right there, and then it goes up to 36, and then it comes back to 35 again. A lot of times what the computer program does is when it goes up to 36 and then it reverses right back down again, it wants to go over a column and leave only 1 entry in the column.
You know, we actually have a slide on this, so why don't we just jump really quickly to this?
Okay, because this causes confusion for students, and
Absolutely.
It's just a rule. It's a convention. And it's an important convention because when you count across, if you only have one, and this goes back to that comment I made about trial and error, the old timers figured out what was relevant, and they figured out that if you just had 2 entries in a column, it counted correctly. If you only had 1 entry in a column, it didn't count correctly. And so this is like just an old convention that it just works right when you do it this way. So go ahead, Ramon.
Okay, well, let's definitely look at these 2 charts. On the top, we have a conventional way of drawing the 1 point reversal, and we see here that there are columns here where there is just 1 box, right here, 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 and then there is a space in between, you know, those columns, right? Here, here, here. For the Wyckoff construction, as Bruce was saying, we have to have a minimum of 2 boxes in each column. So we see that the same data right here, we see how we have at least a minimum of 2 boxes in one column. Where else? Right here. And that's our requirement right here for the construction of the Wyckoff point and figure charts. Now, I'll show you later on in TradeStation how to enable this function, and we call this like a Wyckoff function, you know, for the point and figures. And also what's important that Bruce mentioned is that look at the causality. If we're going to do the counts here, we're going to have actually more a larger count right here, because if we're going to use just one box per column, obviously it expands the whole trading range, and it's more condensed right here. So that's a big, big difference, and you have to understand this and you have to know this because the application for the one-point reversal is going to be tremendous if you're using a conventional point and figure way. Okay.
So this is not it's not uncommon. It is common for students to be confused by this. And so don't be discouraged if it doesn't kind of make sense to you right here. And we can go over it and go over it again. But it's really pretty straightforward. When you're going up, you know, and you're putting in columns of X's, and then all of a sudden you get a one box reversal and you got to go down a box and go to the right and put in a 0. And then you're still waiting for data. And if it keeps going down, you stay in the same column. Well, the only rule is that if you're sitting there with one entry in that column, and let's say it goes back up a point the next day, you have to stay in that same column. You can't go over to the right the way this computer program wants to. You just say, I've only got one entry in this column. I have to put in 2. So if it goes up or it goes down, I have to keep it in that column because I have to have 2 entries there. And it's just a rule. And so just keep that in mind. If you see one entry in a column on a one box reversal, you know that you got to stay in that column whether it goes up or down.
All right. So very important point right here. Okay, let's come back to the construction of the 3-point reversal here. So Bruce, how would we take this data that we've compiled here, 1-point reversal here, and how can we convert it into the 3-point reversal?
So if you create a one box reversal chart by hand, you don't have a computer, you do it by hand, you can easily convert that one box reversal chart into a 3-box chart, in which the reason you do a 3-box reversal chart is because you can get bigger counts in a space, and so you can count bigger accumulation or distribution phases more easily. Shorter term moves are easier to count in a 1-box reversal method. Bigger moves are easier to count on 3-box. So here we have on this point 4 and point 5 is you have the 1-box reversal on the top, the 3 on the bottom. And so you can see here that you have to, at 37 where we started our entry, you have to have a 3-point move in either direction to be able to plot the move. And so you can see here it went 37, and then it went 36, and then it went 37, 36, 35, 36, 35, 34. But when you look at it, you can see that it went 37, 36, 35, 34. There's a 4-point move. So you have in one column down below, you can plot 4 points, 37, 36, 35, 34.
And Bruce, we probably at this point right here, we would draw our, 3 boxes to the downside.
True.
At 35, because at this point, at 35, starting with 36, we already have 3 boxes to the downside, 37, 36, 35. Then we're trying to rally just 1 point. It's not 3. Remember, we have to have 3, right?
That's right. And so then it goes back to 35 and back to 34. So 34 is a new low. That 34 is plotted below on the bottom chart in the same column because those are all pointing down, 37, 36, 35, 34. So that's a very good point, Roman. And then the next column, we know that it went 35 right to 40. So we know it went more than 3. So we knowing it went more than 3, we can go over and up, and we go 35, 36, 37, 38, 39, 40. And then immediately it went back down to 35 again, so that's 3. And so you count downward, you count down to 35. And then you had a series of 1-box reversals there, which don't constitute 3 boxes. And so then at the end, it goes 36, 37, 38. And so now you have 3 boxes up, so you can plot that, 36, 37, 38, and then it goes 39, 40. And so once you have a 1-box reversal chart, you can convert that to 3, and it just takes minutes to do that. It takes longer for us to explain it than it does to actually sit there and do it.
Mm-hmm. Yeah, well, I think it's extremely important to understand how we construct the 1-point reversal. So obviously for big campaigns, we're mostly, as Bruce mentioned before, going to use, weekly charts. We're going to use 3-point reversals, but we're also going to go to a daily chart, to see where we can establish a also So 1-point reversal in the daily chart is also going to be really crucial for us. 1-point reversal also going to be used for us to identify, swings in the trend. We would want to conduct a phase analysis, also a more accurate phase analysis using the 1-point reversal. So it's crucial to understand the difference between the conventional way of how 1-point reversal works and being constructed and the Wyckoffian way. So when I see some comments, saying that some of the softwares do not allow for that 2 boxes in 1 column. Yeah. And unfortunately, yes, that's the case. And if you are going to be using point and figures and specifically 1-point reversal, you have to find the software that will allow you to do this. I remember, Bruce, early on, like in late 90s when, I took Wyckoff 2 class and I started looking at the point and figures, I couldn't find at the time a software that would have, 2 boxes in the column. So what I've actually done visually, I would go to the incorrect way, incorrect visual, and I would just skip some of the columns and I would kind of like visually connect 2 boxes together just to have them in 1 column.
I did the same thing, and I would take a marker and I would connect all of the 1-box columns and make them 2. And then when I went back to count the phase, I would go back and I would count them, or either the column or my mark. And then that way I'd get the correct count. But that was, that's not the way you want to do it. But you do it if you have to. But good news is this, is that I'm going to be starting a blog here for stockcharts.com.
Which is a big deal, by the way, and I want everybody to know that Bruce is going to be blogging on stock charts, and this is going to be a great source for us Wyckoffians to get the information from Bruce on the Wyckoff method. So, Bruce, once you have it all set, just let us know, and we'll definitely distribute the information to all of our students.
Hopefully, with the first post, hopefully the first one will be in maybe even this week or next week. And so we'll get started on that. But what I was going to say is I'm thrilled to be with Stock Charts. They've been they're wonderful. I gave a talk at ChartCon last year, and they did a wonderful conference. And that's sort of what got kicked off the blog. But they have a great point and figure tool. And it follows the conventions. It has the two boxes per column for the 1-box reversal, and they also have some other great features that if we get the time, I'd like to show them to you, because there's ways to do point and figure counting on intraday data, and it's very slick. And so I'm excited to be doing this for them, and I'm also excited for the tools that they make available in point and figure charts.
Okay, well, here we are showing 2 softwares that you can use for your Wyckoff point and figure charting. Bruce talked about the stock charts. We'll definitely in the second and third session, Bruce will show you, how he uses the stock charts for this purpose. I'm using TradeStation primarily, and TradeStation actually has just one small trick here, with the point and figures. There is a function here. If you click on it, it says enable one step back column built-in. So that allows you to have two boxes in one column. So let me just quickly show this to you. Okay, so this is a chart of Apple, and this is 1:3. So I'm going to convert this back to the 1:1. So on the TradeStation, you have this box size right here and the reversal. And this is going to be typical for all of the softwares. So I'm just putting 1:1. And then this is the function right here, enable one step back column built-in. So if I press that, I should be able to have the point and figures where I have at least a minimum of two columns, two boxes in one column. So like right here, right here, right here, and so on and so forth. I can disable this function as well. And then look what's going to happen. I have periods where I have just one box per column. So again, it's an extremely important distinction for us Wyckofians, and there are softwares that allow you to have what we want. So for those of you who are going to use point and figures, it's kind of like, I would say, almost a requirement, to have the software that allows you to have two boxes per column. All right, let's come back to our slides here, and let's quickly talk, Bruce, about how would we construct the data as well. What kind of data we would use? Because obviously we can use end of the day data, the daily data, which will have a high, low, close, open, or we can have even a tick data. We can take the intraday data for the construction of the point and figures, and you mentioned this already. So what do you usually use, and what is the difference if we would use the tick and, let's say, the daily data for the construction of the point and figures?
Well, the charting systems that I've been using for years now use end of day data, and so it's high, low, close, open, high, low, close, and then there's rules it follows, sort of for the range and how it paints those X's and O's in the columns. And my experience with that is that it works, and it works really well. Mm-hmm. Intraday data, if you can get it and are able to draw the charts with the intraday data, you get swings inside of a day. The argument is that you can have a day where you could go 2 or 3 points up or down, mm-hmm. 2 or 3 times during the day and build a count that should be on the point and figure chart over the course of over a day or a few days. And what Wyckoff used to do is he would have either himself or other people keeping track of the swings of the chart, the stocks it would follow inside of the day, and if there was any extra movement in the day, they would plot that. Mm-hmm. All I can say is that my experience with using end-of-day data is proven to be very accurate, and it works very well in 1-box reversal and 3-box reversal. Mm-hmm. And so that's my experience. And what I do oftentimes is I take intraday data, say 30-minute data or 15-minute data, and I'll do a point and figure chart on that. and see the swings inside of the day and see if I can find count in that. I do that a lot. And that you need something like stockcharts.com to do that.
Okay. Yeah. TradeStation also have that functionality as well for those for those of you who use TradeStation. So if your time frame, let's say, is intraday trading and you want to use point and figures, you will probably have to use the intraday data to construct the point and figures, or maybe even the tick data. Look at this example really quickly. So on the top, we have the same data being constructed based on the tick data, and then down here we have the same stock, the same time period, and it's on the daily, using the daily data. And we could see that for somebody who is using a smaller time frame, this information right here is going to be crucial, to understand, first of all, just the consolidation itself and the distribution manner of this consolidation, and then to understand the potential causality of this area right here. Whereas right here, we might be not inclined to see the same type of decision that we might come to, looking at this data. So it really depends on what you trade, what time frame you trade in. So you have to adjust the point and figures for your trading accordingly.
And hopefully we can do some examples of that maybe in week 3.
Right. And I think that we should definitely all work on this, and we can definitely bring some maybe even intraday examples.
I'd say for now the key is keep it simple.
Yes.
Spend this time this week going through, like you can go to Stock Charts. They have free point figure charting that you can do 1 box and 3 box. I know that to be able to do the intraday work, you have to have some kind of a subscription. Even a minimal subscription will give you the intraday data, but you can do the daily and 1 box and 3 box. And just start looking at those and start building up a library of your favorite stocks and ETFs and so on that you'd like to keep track of, and start looking at the point figures on those. And maybe we can pick a few of those out at the end and start to do analysis on them.
Sure, absolutely. Okay, this last example right here on the data selection, the one that you're going to use, this goes to the idea of what to choose, 1 of 3 box reversal. This is just to show how the 3 box reversal here on the lower chart, it condenses the data. So if we have this trading range right here, this is how it's going to look on the 3-point reversal right here. Same data. So you just have to be aware of all of those elements in the construction of your chart, because I would say, Bruce, and please feel to elaborate here again, we're just reiterating the point that a lot of the mistakes are being made even at the earliest stages. It's if we don't understand correctly what to use as our data and what kind of reversals we should have, and whether we're using the Wyckoffian way for the 1-point reversal and so on and so forth. So all of those nuances, if it's not done correctly, then most likely our projections are not going to be correct.
Right. Well, there's a whole count guide that sets up rules by which we follow to determine what we can count and where we count from. And so we're going to be spending time on the count guide for determining that. There's rules for that. Wyckoff is very good about rules and about conventions. And so he'll very specifically tell us where to start our counts from, what to look for, how far to count, so on.
Okay, and such a nice bridge that you built for the for the count guide right here. Okay, we are slightly beyond our 5:30 Indian time, but as I mentioned at the beginning of the session, we might go a little bit over. So I think that if that's okay with everybody, we're just going to continue and just we would like to finish the account guide today, if possible. So let's just continue with the session. A couple of questions, Bruce. Do we use logarithmic or arithmetic scaling? A stock with high momentum seems that it might go through the projected price target of. Okay, so logarithmic or arithmetic scaling?
I always use arithmetic scaling.
Mm-hmm.
And so, and then I typically follow the conventions that if it's over $100 stock, it's $2 per box, $2 per box. And if there's a lot of volatility, I might use a 3-box instead of a 1-box.
Mm-hmm.
Reversal method. So
Yeah.
I do not do arithmetic charts because really when you think about it, if you're using those conventions, it's going to all come out in the wash anyway.
Mm-hmm. Mm-hmm. Okay. Next question. Is there a guideline to choose between 1 versus 3-point reversals? I think we kind of covered this, but let's just repeat this maybe really quickly. So 1-point reversal is going to be used mostly for the daily swing analysis and 3-point reversal for the weekly swing analysis. Is that correct, Bruce?
That's the way I think of it.
Mm-hmm. Okay. Another question. What does point and figure say about the current market? Okay, I think that this question we can address in the second or the third session because we're going to go through the case study of the Dow Jones Industrial Index, and it's going to be based on the work that Hank Pruden actually did for stocks and commodities, and then Bruce and myself added to that analysis a couple of years ago, and we actually published an article together with Bruce and Hank on that case study. So we'll definitely go into that and we'll look at the counts, we'll see where we are right now, and we'll do that in the second or the third session. All right, well, let's talk about the Wyckoff count guide. Bruce, what is the count guide? Why do we need to have it?
Well, the count guide is a synthesis of the vertical charts and the point and figure charts together. And what we do briefly is, and you all are Wyckofians, so you know how to do this, is you go through and you do your analysis of your vertical chart, where you go in, you identify the key points, the climax, secondary tests, a series of secondary tests, the A phase, the B phase, the C phase, which is the final testing of the base, accumulation, and then the markup out of the base, and then the E phase, which is the new uptrend. Is that you have all those points that you're labeling. So, and what the count guide does is it says, okay, you want to take your count of the from the last point of support or from the back up to the edge of the creek, and you want to count that over across the accumulation phase to the climax or the preliminary support, and you want to find those points on your vertical chart. So you go, you've already labeled them, so you identify those points on your vertical chart, and then you go to your point and figure chart and you identify, you find those points which are going to be reversal points on your point and figure chart. Last point of support is that last pullback before it starts its rally up and out of the base, out of the accumulation. So we know, being the last point of support, that it's going to show up as a reversal on a point and figure chart. It's going to turn there. Mm-hmm. And so we would find that point on the point and figure chart. Then we go over and we find the climax or the preliminary support. Those are also reversal points. And so we then take on the point and figure chart and we count across from right to left, and we count the number of columns. And if it's a one-box reversal chart, one box reversal, we count the columns, and then we multiply that by the scale of the box size. So let's say it's a one-box reversal chart. So let's say it's 20 across. Mm-hmm. It's one box. It's one point per box. So it's 20 times 1, or 20 points. And we count up from two places. We count up from the lowest low on the accumulation range, and we count from where the count line is, which is the LPS. So we draw a line literally from the LPS across, or if we're taking it from the back up to the edge of the creek or some other place, we count from there. And then we count up 20 points from there. So these are the rules that we follow, is that we follow these conventions where we base our counts on our vertical chart analysis. Mm-hmm, mm-hmm. Okay. So we'll do a lot of this. So I'm describing this to you. Right. It's going to be easier to explain when we look at a chart. Yes, and I know that you all know what we're talking about because you've done this work repeatedly. Mm-hmm. Mm-hmm. Okay, and we actually will do this as an example right now. We'll show an example of how we would go through the count guide right now, step by step, to identify all of these, count guide points right here. Bruce, I think that the big one of the also biggest mistakes for students is that they tend to forget that they need to use a count guide. So it's almost like the first step for some of the students, and I only say this because I've seen a lot of the same mistakes being repeated over and over, and the first mistake is not to use the count guide correctly. The second mistake that I see that is extremely common is go to the point and figure charts right away. And we know that we have to start with the vertical charts, right? With the bar charts. And we have to identify, as you said, all of these points for our accounts. So why don't we do this right now? And we're going to look at this case study. This is an Apple in 2008-2009 trading range, and we're going to look how we're going to take this conservative, regular, and aggressive counts, and I think we're only going to talk about the conservative and regular. So the first thing that we have to do is we have to refer to the vertical chart. We have to identify where our count is going to start and where our count is going to end. This is the first step in the count guide. So Bruce, here is this trading range right here. And because we have quite a few, well, the majority of participants are advanced Wyckoff students here, we can talk about, different, interpretations here. I put phase C with the spring here as the lowest point, and I put the sign of strength here as the price commits above this resistance cluster right here. It's a little bit of a sloping down trading range. We can also put the horizontal lines as well. For those of you who are attending, my advanced Wyckoff courses, of course, this is not, something new. So we're just gonna skip this as an idea for the phase labeling right here. But let's concentrate on where would we take those counts. Bruce, how would we look at this trading range, and where would we start our count and where would we end our count? So we identify the last point of support, and so we can see right there exactly at that place. That's a higher low from the spring, but it's also the last place that it stops, which the price never returns to that place again and starts its markup to the top of the range and out. Now, we certainly seek to identify and commit ourselves to that LPS as close to that price point as possible with some part of our capital, maybe a third of our total position. But that's a discussion for another day.
Mm-hmm.
And but the LPS, once that turn occurs, and you can see those big, easy moving wide bars as it starts to mark up into the range as it's working its way to the top. That LPS, we put that down, and we draw from the LPS all the way across to the selling climax area. And we say, okay, we want to find these 2 points on our point figure chart.
Okay, let's go to the point and figure charts right here and find those places, right? So in here, I'm showing both 3-point reversal here at the bottom, and then a 1-point reversal chart right here. And let's start with the 1-point reversal. So this is the second step in the count guide. We would have to identify the same points on the point and figure as we did on the vertical chart. So here is our LPS right here. And then here is our selling climax area right here. So Bruce, another question that regularly comes from students is, well, do I take the count from the 0 or from the X right here?
Just take the count from the lowest point.
Mm-hmm.
And then also you want to take the count from the low. So that would be the place of the spring.
Mm-hmm.
So you want to go over and find that low on the spring.
Yeah. Okay.
And now you're not counting from the spring, but you're going to count from the lowest low in the accumulation range and draw a vertical line straight up, and you're going to count. You're going to make 2 marks on that flag pole. One is from the place you counted from, and the other is from the lowest low in the accumulation range. Because you're just looking for a range.
Okay.
You're identifying a range.
So let me rephrase this a little bit. So we are gonna, in the accumulation, whenever we take the count, we always will take the count from the columns of zeros.
Yes,
we want to.
That's what you meant in that question.
Mm-hmm.
Yeah.
We want to find that reactionary low, the lowest point in the reaction. And by the way, the price might go even slightly lower on the vertical charts, but this is the lowest full point that we're going to have in this reaction. So we're going to take it from this 0 and going to, as Bruce said, extend it to the left to the climactic action here. And also Bruce was talking about defining the range. On which line are we actually going to start our count to the upside, right? Can we take this line of the LPS, which is going to be right here? This is the line. Or should we take it here as the, spring creates the lowest point for us in the trading range? And we're going to
do both.
And we're going to do both, yes. Yep. So we're going to have a maximum projection, which is going to originate on this line right here, which is higher. And we're going to have a minimum projection, which is going to originate on this line of the spring. And then Bruce mentioned before that as an objective, the price does not necessarily have to hit an objective exactly, to the point of which we are counting. Wyckoff was referring to those objectives as areas. So, and we see here how we're creating this area. It's being created between these 2 points, the maximum projection point and the minimum projection point. And then in between, we might also have a 1/2 point. So we would take the projection and calculate, let's say the maximum is going to be here, the minimum is going to be here, and then 1/2 is going to be here. Bruce, why would we do this? Why do we need this area?
Well, the way I like to think of it is the accumulation. The accumulation is the entire width of that range.
Mm-hmm.
And so from the very lowest low to the highest high, that whole thing is an accumulation area. And I always try to think in terms of the composite operator. The building of a position in a stock like this, the goal of the CO is to accumulate their shares on average in the middle of the range. If they can accumulate their average cost for the entire range as they build their position of millions of shares, is if they can average the midpoint of the range,
mm-hmm.
they will have done their job. If they pay above the midpoint of the range, they've probably not done as good a job as they wanted. If they pay below, they've done a little better job. And so the CO is using the accumulation range as an area to conduct their accumulation for their campaign. And so taking the midpoint of the range for account, especially if it's a wide range, I think is a very important thing to do, because we're counting from where the CO has average cost his or her position.
Mm-hmm.
And so I think the midpoint of the accumulation range is an important area to count from the low, from the LPS, and from the midpoint of the range.
Mm-hmm. All right.
That's the way I think of it.
Okay, great. Okay, let's come back to our account guide right here. So we've talked about identifying LPS and identifying a climactic action. And this is our most conservative count across the whole trading range. So we're not talking about the phase analysis yet. We're just taking the most conservative count possible for this trading range right here. Now, it's very easy to do it with this LPS right here. Why? Well, because this is a reaction right here. And we know that for accumulation, we have to start with the column that's going to go down. Now, what about the counts that are going to be slightly higher for us? You know, we have to find those places. Just to come back really quickly on this count right here from the LPS to the climactic action, when we go to the 3-point reversal chart right here, we would do the same thing. We would identify the LPS and we would identify a climactic action, and this is going to be our count right here. Now, let's imagine that we want also to look at the higher counts, more aggressive counts. And maybe we want to look at the position that is going to be originated somewhere after the sign of strength on the backing up action right here. And we see two reactions here, here and here. We see one more reaction on the sign of strength itself as an LPS. And we can take the counts there as well. Sometimes, because there are no 3 box reversal here on these reactions, we are not going to see those on the 3 box reversal chart. Look at how massive this rally is. It doesn't show us any of the reactions, any of these points, LPS or backing up action right here. So what we will have to do on the 3-point chart right here is that we would have to refer to the 1-point chart reversal and to find these points of reactions for us and to understand which line is it on, and then to find the same line on the 3-point reversal chart and just to make this projection.
I would even add to that you should actually find those LPSs and the back up to the edge of the creek. You should find those on the vertical chart.
Yes, absolutely.
And then you find them on the 1-point and then go to the 3-point, which is what you're saying is exactly right.
Okay, and we would come back. Again, this was easy for us because this definitely has a reaction. And then on the way up, we might identify these reactions right here and specifically this reaction right here. So as the objectives are being fulfilled, we might look at the more aggressive count. So if this objective has been fulfilled for this count right here, what is the next thing for us to do? Well, we have to think that if the trend continues, this is going to be most likely the next most probable count for us, on the backing up action right here. But we have to find it on the point and figures, and specifically on the 3 box reversal right here. Okay, so Bruce, I think that would be valuable, and we actually already probably should stop here. But before we go, let's quickly go through this count and kind of like show the mechanics of how we would count. So let's say that we are here at the LPS. What would we do next? We would just count the columns?
Count the columns and count them all the way over to the first column, which is the selling climax labeling.
Mm-hmm.
And so we have 5 box grids here, 5, 10, 15, 20, 25, 30, 35, 42, 43. So we have 43 columns, if I did that right.
Okay.
And we can see that each one of these boxes is the scaling is 1 point per box.
Mm-hmm.
And so it's 43, and it's 3 box reversal, so we multiply 43 times 3.
Times 1 times 3.
Right, times 3 for the 3 box reversal, times 1 for the scale, 129.
Mm-hmm. 129, and then we would add this count, 129, to the line where we actually are taking this count. So it's going to be 83. So, and that's going to be our objective, 211, right here.
212.
Correct?
212.
I'm sorry, 212, yes. And that's basically what we would do. And also, as we've discussed, we would have the minimum and maximum objective in 1/2. And here with this backing up action right here and taking this at this level, at this 104 line right here, we would do the same. We would calculate the number of columns. So this column would go in. And this is basically the count right here that we would get. And this count is going to be higher than the original, conservative count right here. And it has to be because we are expanding our causality right here and the whole count.
Now, this brings up a tactical point. Actually, that's around the price level that it went to right before the flash crash. So it went right up to that level.
Mm-hmm. Yes.
So you can go. It'd be good to go look at that stock subsequently and what it did. Oh, you did
here.
That. Yeah.
So good. This is the flash crash.
Yeah.
And we had an objective of 259, I believe, and it went to about 275. So it's actually a good run right here, and we are almost hitting the objective right there. And see how it does not necessarily have to hit that objective. It can overshoot or undershoot, but
Richard Wyckoff said that when you hit a price objective on a point and figure chart, that's not a place to automatically sell or to cover if it's a top to cover your short or to start buying. It's what he would call a stop, look, and listen point. So you start to look for evidence or the cues of stopping action. And so it could be a stepping stone, the beginning of could be the beginning of a stepping stone action that could take some period of time, or who knows, there's any number of things that could happen, but it's not a reason to automatically start selling your stock.
I think it's extremely important point, because in some instances the count will work extremely accurately, and it's going to point to us the end of the campaign. But in a lot of cases, it's just going to point to that area of the stepping stone, just a consolidation where stepping stone might develop the new count for us to the higher objective. And we'll talk about this next time. All right, Bruce, I think that we should probably stop here for this first session. I mean, we've covered all of the material that we wanted to go through today. We have a couple of questions here, actually more than a couple. Let's address those. A question, where do you take count on distribution? We will talk about the distribution. There are definitely some nuances about the distribution, and Bruce actually has such great insights on that. Bruce, I think that maybe next time we'll talk about the distribution and we'll bring some case studies.
Great, because it's similar to the accumulation turned on its head. But there are, as you know from Wyckoff analysis, there's difference between the way distribution unfolds and accumulation. And the counting rules for distribution are a little different, because it's very easy to count a distribution and get a count that takes you below zero. And so to get accurate distribution counting is an art all its own, just like this is, but we will cover that, and so that you have some very good rules about how to make sure you're not over counting, or you get frustrated because you're counting a distribution and you get a count to like -20, which does you no good at all. So.
All right. Next question. What bar to the left do you stop counting? And I think that the reference here is to this area of the climactic action. So my count here, and this is why the number was slightly different from the one that we've calculated, I assume. I've actually calculated it to this point right here. Bruce, would you count to this point, or would you count it more to this point right here as the climactic action?
Well, I always think in terms of where's the place where you get the big automatic rally.
Yes.
Because when you have a really big preliminary support and the selling climax, these are tentative climactic lows. But you don't know that you have a climax until you have an automatic rally. And so to me, I always look for that place where you have that big outsized move that shows that at a price, large interests are willing to buy stock and turn the trend. They're willing to defend the stock at a price, and that's what creates that automatic rally. So I think that that's a very important place, and I always attempt to find that automatic rally place and the selling climax that precedes it. And those are very important to me. Whether I get a count to preliminary support, sometimes you get good preliminary support, sometimes you don't. And so that's less important to me. But when you see, you'll know it when you see it on the chart. But to me, the all-important place is not the climax, but the big bouncing automatic rally that comes after, because there's where large interests are willing to support a stock at a price.
Okay.
So now, that to me is what I look for.
Okay. Well, I'm obviously looking for area of congestion right here as the first attempts to rally. And
well, that rally went from 89 to like 100, which I think qualifies very much as an automatic rally.
Well, it does look like a change of behavior right here. I mean, this is probably what maybe of the same magnitude. but on the lower price scale, this is more
Yeah.
significant.
Yep.
Okay. Next question. How does one know the LPS point on point and figure is the same point on the vertical chart? Okay, well, we're talking about this point right here. So we would just refer to the price scale, price on this line, and also we would refer to the price action itself. So that's how we would find this point right here.
Yeah, with some practice, you'll be able to do it, and it's a price point. If the price point for the preliminary or for last point of support is $43 on a chart, you'll be able to find that point on the point figure. And that's the reason you find it on the vertical chart first.
Okay. Next question. The one where you have 43 by 1 by 3 box, and this was the example where we were counting, the columns. So we said 43 columns times $1 per box times $3 reversal. So this one, yes, this is the size of the box. Next question. How do you use the count on the smaller chart on this screen? Okay, so I'm thinking this one. So we would use it the same way, right? So we would identify the last point of support, project it, count it, and do the same thing.
The difference being it's a 1-box reversal chart instead of a 3-box, and so we'd go however many columns that is times 1 point per box times 1. So because it's 1-box reversal, so let's say there's 60 there.
Yeah.
So 60 times 1 times 1.
Yeah. So instead of 43, we're going to have more number of columns. So let's say, and this is just, we're not counting the columns. So theoretically, we're just saying, let's say instead of 43, we're going to have 63 times 1 times, instead of 3, now we are calculating it as 1 right here. Okay. Next question. How do we move our stop loss with the point and figures? Okay, I think that we're going to skip this question for now, Bruce, because
it's a good question. It just needs some time.
Yeah, we just need to go through all of the techniques and elements, the concepts for the count guide, and then we'll definitely show, and this is probably going to be during our third session with the case studies. This would be a good way for us to show how the stop loss could be moved there. All right, next one. Looks like we do not need to look at the vertical chart. The point and figure shows climactic action, selling climax, and LPS. Am I missing something? And Bruce, I think that this is where this confusion is, because I think that for experienced Wyckoffian, and at some point you kind of feel that you see this on the point and figures chart, you can identify the climactic action and all of other points. I mean, as you were talking about the climactic action, this big rally looked like an automatic rally right here. So we know that the next move to the downside is going to be our secondary test, phase A. We know that the lowest point is going to be our spring, and then the change of character to the upside is going to be a sign of strength, backing up action, and so on and so forth. You can definitely do this, but for the purposes of the correct counts, I would still go to the vertical bar chart, and this is where your analysis will start anyways. So you have to label the vertical bar charts first, and then to refer to the point and figure charts. Bruce, maybe you can elaborate here.
I would only add, very good point, I would only add this one thing, because it's very easy to just sort of get caught up in the point figure charts and then just focus on those because you're pretty sure of what you're seeing. Is that on a vertical chart you can see elements and attributes of absorption that you can't see in a point figure chart. And so you can look at a point figure chart and it can look really good. And you don't look at the vertical chart and you don't try to confirm that in fact there's evidence of strong accumulation occurring in the accumulation range. And you end up missing a really key element. And that is that the stock is truly under strong accumulation by the CO. And that's easier to see in a vertical than it is in a point figure.
Yes. So there is more information on the vertical chart for us to make some kind of directional bias decision as to whether this is accumulation and we're going to have an uptrend, or distribution, we're going to have a downtrend.
Yeah.
All right. Well, Bruce, I think that we probably need to stop here. There are no more questions at this point, so I'm glad that we've covered all of them. Thank you so much for spending this time with us today. And the next session is going to be in a week time, next Monday, on May 11th at the same 4 p.m. Pacific time. So we are looking forward to seeing all of you back, and we will talk about more. We're going to finish with the count guide. We're going to go through the case study on Apple, and we're going to talk about more advanced features for the point and figures like phase analysis and the timing mechanisms. Usually in our classes, we do have homework. There is no homework for these sessions, so just make sure that you come back next week. Thank you, everybody, and Bruce, thank you so much.
Thank you all.
Bye-bye, guys.
See you in a week.